All right, so I think we're live here. Welcome to the third monthly installment of CORA College. My name is Justin Hewins, and I'm a partner at CORA Capital and serve on the firm's investment committee. Today, we are bringing you an economic and market update from one of our top partners, JP Morgan. Meera Pandit is a global market strategist on the JP Morgan Asset Management Global Market Insight Strategy team. Meera is responsible for delivering timely market and economic insights to institutional and retail clients, conducting research on the global economy and capital markets, and running economic forecasts. She is also responsible for publications such as the Guide to the Markets and is a contributor to the JP Morgan Long-Term Capital Market Assumptions. So Meera, thank you very much for being here, and I'll let you take it away.
Great, thank you for having me. Thank you all for joining this afternoon. A lot has gone wrong this year when we think about some of the banking issues we are dealing with in the month of March and into April, the Fed continuing to raise interest rates, and of course, the debt ceiling, which we are hopefully avoiding the worst of at this point. But also a lot has gone right when we think about the resiliency of economic growth, of the labor market, the fact that inflation is slowly but surely dissipating, and the fact that markets are up almost 10% year to date. And I think what that brings about is a really important dynamic that we see often in financial markets is that markets often lead the economy. Or as someone put it to me the other day, markets and the economy look in opposite directions. Markets are forward-looking. They start to discount a range of different outcomes and really start to price in some of the bad news. Whereas the economy is backward-looking. It's looking at what people did, how the data played out is usually on a lag. So I do think that's helpful in understanding how we think about 2023, because while we do expect that we could fall on harder economic times, we could see slower growth ahead, potentially a recession. We do think that a lot of the risks out there are well understood by the markets at this point. And I think that's why you've seen a greater degree of stabilization in markets as well. So if we take a look at a couple of the slides that I've organized from our Guide to the Markets, we'll just bring those up in 1 second. Oh, Brittany, you're on mute.
Hi, could you enable my ability to share slides?
So as we're sharing the slides, let me just kick off and talk a little bit about what we think is potentially going to happen with the economy this year. As I mentioned, we came into this year with pretty strong economic growth, stronger than we had initially expected. But growth has been giving us very mixed signals over the last year or so. We started off with negative growth in the first half of last year and ended the year fairly positive. And then coming into this year, things have thus far turned out better than expected. It's been a long forecast recession that has not happened yet, since we've effectively been talking about it since early January of last year. Now, if we think about what's actually going on in the economy, what we started to look at is a number of different indicators that give us a sense, again, in real time, what's going on with the consumer and economic activity. And the reason why we are so focused on the consumer is because the consumer drives about 70% of our overall economic growth. So it's a really important indicator of how we're doing overall. So we started to look at a range of different indicators, things like consumer spending, consumer income, retail sales, industrial production, different measures of jobs to get a good sense of how the consumer is doing. And what we saw going into last year is there was more of a slowdown. Coming into the beginning part of this year, data looked pretty strong. And now data is looking a bit mixed. So while we don't think we're in recession yet, we do think that this slowing momentum means either we're going to see a significant slowdown in growth from here on out, or potentially a recession by the end of the year. So you can see on this slide here some of the different indicators that I had just mentioned. The way the color coding on this chart works is essentially like a traffic light. green is growing, yellow is slowing, red is stalling or stopping out. And again, you can see that where we've gotten to at this point is a bit of a mixed bag in terms of some orange, some red, some yellow, a bit of green. So again, that mixed bag that signals to us we're not quite in recession yet, but we are certainly slowing down towards one. If we take a look at the chart on the bottom, essentially what this index looks at, it's the City Surprise Index of economic data. When economic data comes in, people have a forecast. If it surprises to the upside, you'll see this line move higher. If that data surprises to the downside, it will move lower. And it's hard to see some of the differentiation here. But essentially where we started the quarter in March 31st was at about a 57 was the reading. And now you can see here we're at about a 3. So again, slowing momentum in the economy, potential recession by year end. Now, if we think about some of the different banking issues that went on earlier this spring, that essentially compounds the issue. Not because we think we're going to have a financial crisis. We're actually seeing a lot of stability within the banking system after that episode. But if you are a small regional bank and all of a sudden you have to tighten up the amount of lending you're able to do, and you see less of that loan growth and therefore less of that profitability and less of that ability to hold on to deposits, that's going to put some pressure on your balance sheet because you might be able to pay, a nominal amount of interest on deposits, whereas in a money market fund or a short duration fixed income, you can get pretty attractive yields and T-bills. So that's putting some pressure on some of these small and regional banks. That's going to lead to a slowdown in credit growth. And when customers and businesses can't borrow, that is a drag on the economy. So that will also have an impact on this slowdown of growth overall. Now, when we hear the word recession, we think about 2008 and we think about the pandemic. And of course, it brings about, how severe could this recession be? Well, I think it could be potentially pretty mild. I mean, again, I think we've been talking for a while about just about going into recession, whereas if we think about the pandemic and the financial crisis, you didn't really need to look at any data or any charts to understand that we were in a recession because it was pretty severe right off the bat. So I do think that the fact that we're even debating whether or not we're going to go into recession means it's probably going to be reasonably mild. Typically, when we go into recession, we see some forms of excess. Too much home building, too much inventory, too much auto building, businesses are spending too much money. We're not seeing a lot of those excesses. So precisely the types of things that tend to amplify the nature of recessions are not at play today. The second big reason, if we take a look at the next slide, is that the labor market is still really strong. If we think about the layman's definition of a recession, if my neighbor loses their job, it's a mild recession. If I lose my job, it's a severe recession. And yet we're seeing an unemployment rate all the way down at 3.4%, which you can see in the gray line here. Now, I do want to caution that while this is an ultra low unemployment rate, we do tend to see that employment is a lagging indicator. As we go into recession, first you start to see things like housing and manufacturing weaken, which we've seen. Then you start to see profits weaken, which we are in the process of seeing. And very last, you see the labor market start to fall over. In fact, usually it takes about 8 months between that bottom in the unemployment rate and until we actually go into recession. So that still potentially puts us on track for recession by the end of the year if we think about this April reading as potentially around the bottom of unemployment. But the reason unemployment is so low is because we do have this structural shortage of workers in the economy. You're seeing still a lot of help wanted signs. We saw an uptick in already very high levels of job openings just this morning. So I think that when we head into the next recession, we're not going to avoid this cyclical pattern of seeing slightly higher unemployment, but we're not going to necessarily see the heights of unemployment that we did during the last 2 recessions. So it will limit us from seeing the 10% unemployment rate we saw in October 2009 or almost 15% in April 2020, but maybe we see something more like 5 or 6% unemployment. And I also think that means that unemployment can come down a lot quicker than it has. We used to say that unemployment rises and falls like a playground slide, moves up very sharply, comes down very gradually. But I think now it'll be a little bit more like a fairly steep slide because people are just having, minimum demand for workers that when they're able to bring people back quickly, they will. So that's how we would anticipate the labor market playing out during a period of recession. Now, the other quirk of this labor shortage is, of course, it's pushing up wages because a shortage of workers means people can demand more money for the labor they're willing to do. And what you can see in that blue line there is wage growth today versus 1 year ago. And while it has accelerated quite a bit since the early days of the pandemic, it is starting to roll over a bit. And I think what's important when we think about this from an inflation perspective, because our central bank, the Federal Reserve, is very concerned about high wage growth pushing up prices even further, is that inflation has eroded wage gains and outpaced wages for the last 24 months. So not everybody's wages are going up and certainly not equally, but everybody's feeling the heat from higher gas prices, higher grocery prices, and those bills are going up at a faster pace than wages themselves. So that is not something that concerns us particularly when we think about wage growth and how it relates to inflation. Now, if we take a look at the next slide, inflation, of course, still is one of the biggest challenges we face as an economy. It is coming down, but it is certainly not out yet, but we are making progress. So what we can see on this slide here is we look at headline CPI, the consumer price index, which is essentially a broad measure of consumer prices. And we also look at core CPI in gray, which is ex food and energy, just because they tend to be a little bit more volatile. Maybe another way you can think about core CPI is the things that are under the Fed's influence, because the Fed, by raising rates or lowering rates, doesn't really have a whole lot of influence over food and energy prices, which are really driven by the supply of food and energy. But what you can see here is just in the way that that unemployment tends to rise and fall like a playground slide, you tend to see that inflation resembles a little bit more the Eiffel Tower, where it rises very sharply, but then it tends to come down pretty sharply as well, particularly during periods of recession. And what we've seen so far, despite the fact that many say, oh, inflation is coming down so slowly, is that actually it's in line with that pattern that we've seen in the past, which you can see visually there in that blue line. Inflation was at almost 9% on a year-over-year basis last summer. And based on the patterns that we're seeing right now and what we expect from May and June, just because last year's May and June were so hot in terms of inflation, year over year, that's going to help bring these numbers down. So by the middle of the summer, we expect we could be at about 3.5% inflation. So on this journey from 9% last summer to 5% today to potentially 3.5% by the middle of the summer, it will take a long time to get back to the Fed's 2% target. And that could perhaps take an additional year. And it might require a recession to stamp out some of these higher prices once and for all. But we are seeing that gradual progress in inflation. And to understand why, let's think about some of the drivers. When we had that spike in inflation from last summer and leading into last summer, we had supply chain issues, a spike in commodity prices, massive demand for goods throughout the pandemic that actually compounded those supply chain issues. But we're seeing that supply chain issues have normalized. Commodity prices have settled around a stable level. And from a goods demand perspective, people don't want the Pelotons, the laundry machines, or the big ticket items anymore. They want services. And that's where inflation is still putting a lot of pressure on prices. So when we think about services, people want to go out to restaurants, people want to go out to travel. But when the consumer has to tighten its belt, which eventually it will, the easiest things to cut out is that extra night out to dinner or that extra trip. So I do think that those areas can be alleviated. And then the last big area where we're seeing more inflation is rents. But the way inflation measures rents is highly theoretical. We're seeing housing cool. We are seeing rents in the real economy start to come down. So we do eventually expect that rents too will start to come down and we will continue to see inflation recede. Now, if we take a look at the next slide, over the course of the last year plus now, the Federal Reserve, our central bank, has raised rates rapidly and to a very sharp and high magnitude here relative to prior hiking cycles in order to combat inflation. And so we've been on this journey from 0% rates last March all the way up to above 5% rates today, which you can see in that gray line on this slide. The question is, where do we go next? We're going to see the Fed convene in about 2 weeks' time. We're hearing mixed messages from Fed officials, some saying we want to hike one more time, others saying we're ready to pause here. If we look at what the Fed was saying just back in March, on a quarterly basis, they reveal what our projections are for where they think the federal funds rate will go. And in that blue line there, they expected to keep the federal funds rate where it is today through year end. Now, markets expect something slightly different, which you can see in that green line. Markets actually expect the Fed to cut modestly by the end of the year, but these expectations have been moving around quite a bit. Now markets are hearing the fact that the Fed says maybe we need to raise rates one more time, starting to consider that possibility, expectation for fewer cuts by the end of the year. But I think the broader point here is if you look at the shape of this gray line and you look at some of the expectations for year end in blue and in green, we're not all that far from a pause point. Even if the Fed has to raise rates another quarter point, we are mostly there when it comes to the end of this rate hiking cycle. And I think the reason why that's important for investors is because last year, as rates were moving up higher and expectations for rates were moving up higher, the S&P was moving lower. It was almost a perfect X when you looked at interest rates versus the S&P 500. And so now that we're getting a lot more stability around where rates go from here, I think that's also why you've seen a bit more stability within equity markets, because the understanding of where rates go is essentially much better understood. Now, if we take a look at the next slide, of course, the impact of the Fed raising rates as sharply as it did last year meant the equity market did very poorly, as did the bond market. So a lot of people say, well, it's going to take forever to recover what I lost from last year. But the reality is we could actually be looking at some reasonably attractive returns on the way back up as those who suffered the sell-offs start to gain from the rebound. So what we can see in the chart on the left is we don't do forecasts, we don't do S&P price targeting. All we're doing here is assuming just back of the envelope math that we get back to a peak in the S&P 500 at some point, which is not unreasonable because the S&P 500 has never failed to regain a prior peak and then surpass it. So eventually we're going to get back to that January 2022 peak, but it might take some time. And let's say that doesn't happen this year, and maybe it doesn't even happen next year. Maybe it takes 3 years for the S&P to fully recover back to prior levels. Well, if that were the case, you'd still be looking at about a 6.3% return each and every year on the way back up, which if we think about when we're establishing our portfolios, somewhere between 6, 7, 8% is the typical expectation for equity markets. So the ride back up could be pretty fruitful in terms of regaining some ground here. And if it happens in less than 3 years, you're looking at 8, 9% returns, potentially double-digit returns on the way back up. So we can be a little bit patient here, despite all of the uncertainty, with the fact that we do think that markets are gradually beginning to recover. Now, still, we get a lot of pushback from clients on if this is the right time to invest, if equities are the right thing to invest in. So if you take a look at the next slide, even though it doesn't feel like a great time to invest, with still a number of uncertainties ahead and a lot of headwinds on the horizon, what we tend to see is that consumer sentiment is a poor guide for investing. So what this slide here shows is the consumer sentiment index over time. You can see where we are today is below where we were earlier this spring because of some of the banking issues. We are just above where we were in June of last year, which was an all-time low. But we're about the same place we were in terms of consumer expectations as we were back in the financial crisis. So well below those long-term averages in that dotted line, people are not feeling particularly good about the economy and markets. But when you overlay investment returns, if you were to invest at the peaks of consumer sentiment, when people were feeling their absolute best about the economy and markets going forward, your return 1 year later in those blue dots would have been about 3.5% on average. But if you were to invest during the bottoms in consumer sentiment, when people felt their absolute worst about the economy and markets, 1 year later, your return would have been almost 25%. Now, again, that's not saying we're going straight up 25% from here. I think we could continue to see some degree of volatility within the markets over the next several months, given some of the uncertainties that lie ahead. But when we think about the basic principle of buying low and selling high, the reason why that's so hard to do is because we often feel the exact opposite when those opportunities present themselves. So it's not a terrible time to be in the equity market. Valuations are not all that expensive, especially when you take out some of those top tech stocks that have really rallied hard this year. The rest of the market looks reasonably priced, and there's some scope for upside over the next couple of years. Now, if we take a look at the next slide, of course, I fully understand that you can just buy a CD for 6 months and get a 5% rate. But the reality is, it's not about what you're locking in today in terms of income and return. It's about the opportunity cost of tomorrow. So what you can see on this slide here is the peak CD rate during prior Fed hiking cycles. So rates were moving up, CD rates peaked. What type of return would you get 1 year later in that CD in gray, in US Treasuries in blue, in investment grade bonds in purple, and in high yield bonds in green? So broadly, high quality bonds, government bonds, and also some of the riskier bonds in green. And what you can see here is in a CD, at best, you lock in the rate that you get in the CD. But for a year span, if 6 months later that CD expires or matures and rates have gone down, you have some reinvestment risk that what you got at 5% today is going to be 4% in 6 months' time. So you can see why some of those returns look a little bit less than that gray diamond. But if you think about different areas of the bond market, not only do you get to lock in a reasonable income at this point, similar to a CD, but also this is the highest that rates are tending to get. And what happens is typically after rates rise, they start to come down. Rates are a function of what the Fed is doing, of growth, inflation. Eventually, the Fed will start to cut and normalize rates. Eventually, growth and inflation will slow as we expect throughout the year. And that's going to bring yields down. Yields down, bond prices up. That's why you see those types of returns in the purple and blue bars, because you're getting income plus capital appreciation from bonds as they protect and serve as a form of diversification when those yields do come back down. So don't just think about the income you're locking in today, but the opportunity cost of being in something that has no sensitivity to interest rates for tomorrow. Now, if we take a look at the next slide, we can see this essentially playing out in real time today. So if you take a look at this chart here, and I know it's busy, so I'll walk you through it left to right. Essentially, it looks at the top to bottom ranking of various asset classes from 2008 through year to date. So for example, if you look all the way back in 2008, fixed income in navy blue, bonds were the best performing asset class. Emerging market equity in light purple was the worst at the bottom. And then we also look at a diversified portfolio that's made up of all of these different blocks, and that is connected by the black line in those gray boxes that sort of cuts down the middle of the slide. If you look all the way over to the right and you find that year-to-date column, the third one in, what you can see is the message from the prior slide is already playing out, that opportunity cost of being in cash. Because even though cash was one of the top performing asset classes last year, this year it is one of the bottom. It is only doing better than REITs and commodities. But you're seeing that bonds, both core bonds and risky bonds, small cap equities, emerging market equities, large cap equities, European and Japanese equities are all doing better than cash already this year. So that point is already borne out that we have an opportunity cost and risk missing the rally that may not entirely be obvious that it's going to happen beforehand when we sit in cash. What we can also see is that for all of the struggles of the 60-40 portfolio last year with stocks and bonds both down, this year it's in the third highest slot there. And what we also see over time, if we look at those final two columns on this slide, is we look at the last 15 years worth of returns and volatility. And what you want is a box that is pretty high up on returns and pretty low down on volatility. And that is exactly what you get with asset allocation, that diversified portfolio in gray. Delivers a smoother ride and a more stable outcome within portfolios over time. Now, if we take a look at the next and final slide, I just want to make a fine point on diversification and tie this back to where I started. Last year was not a good year for diversification. You can see in this slide here, the return of a 60-40 portfolio 60% equities in that lime green, 40% bonds in gray. And you can see that last year we were down 16% on the 60-40 portfolio, and both stocks and bonds were down. You'd have to go all the way back to 2008 when we were down 20% to have a worse outcome. And if you go all the way back, you'd have to go back to 1974, down 17% to find a year where both stocks and bonds were down. And I think that's an important point because it's been 50 years since we've had a calendar year when both stocks and bonds were down. So it is an exceedingly rare occurrence. Diversification does not work every time, but it certainly works over time. And what we also see, to the point that I made up front about market cycles and economic cycles not always tightly aligning, markets being forward-looking, economics and the economy often being backward-looking or looking at where we are in the present, you can see that in market returns here too. Because I mentioned 1974 was a very bad year, but 1975, we were up 28% and both stocks and bonds were positive. 2008 was a very bad year, but in 2009, we were up 18% and both stocks and bonds were positive. If we think about the order of operations in 2009, you saw markets bottom in March. We exited a recession in June, and actually unemployment continued to rise until October when it peaked out at 10%, which we saw on one of the prior slides. So markets often bottom before the worst of the economic outcomes. And that's why I think it's a useful guidepost for how we think about last year and this year. Last year was all bad news, markets pricing in a number of really negative outcomes. And yet this year we're positive year to date, even though we haven't even seen all of those outcomes, whether it's recession or any other type of major shock. So I do think it's important to keep in mind that while this year we might not see returns move in a straight line as they essentially have thus far, we could actually start to see a bit more volatility within markets throughout the rest of the year. But this is apparently, as we're experiencing right now, the early stages of a recovery in the markets, given all of the bad news that was digested last year. So maybe with that, I'll pause there and happy to open things up for questions.
All right, Meera, thank you so much. Great information. If you have any questions, please feel free to type them into the chat box, and I will relay them. Meera, I don't know if you have access to them, but I will do my best to either answer them or pose them over to you if we get any in the question and answer section here. All right, so question coming in, how do you see 2023 ending? Which can certainly be a loaded question.
So I do think by the end of 2023, it is possible that we see this economic slowdown result in a recession. If we don't see an outright recession by the end of 2023, I think that we could potentially be in a pretty meaningful economic slowdown. But I'd also say that with that should mean that inflation is around 3%, maybe a little bit higher than that, certainly not all the way back down to 2%, but I think you continue to see a bit of progress on inflation, but economic growth certainly slows. From a market perspective, therefore, I think that between now and the end of the year, you might see a little bit of a correction. I don't think we have to go all the way back down to the levels we were last October when we had that market low within the S&P 500. But look, we've come further this year than I think most people would have imagined, up 8-9%. So maybe we do see a pullback of a couple of percentage points as some of this bad news potentially comes to fruition. So I think that from that standpoint, we want to be attentive to the fact that markets might experience a bit more volatility. But at the same time, for every one person who says we're going into recession, there's one person who says we're going to avoid it. We're going to have, we're kind of muddle through and not see the worst of this. And therefore, we really don't need to see a much worse outcome in the markets itself. So people are pretty split on exactly how 2023 plays out. But that's why I think that we're not waiting around on the sidelines when it comes to investing, because we've already seen this 8 or 9% rally this year. We don't want to miss the next 8 or 9% if that is what's in store. So I don't think it's necessarily a deterrent for wanting to make decisions within a portfolio. But I also don't want to be overly optimistic that all of the worst is behind us and smooth sailing from here.
Great, thank you very much. Any other questions? Happy to take them. Well, it doesn't look like there's any more coming in, so I guess at this point we'll wrap things up. Meera, again, thank you very much for the information, the presentation. It was fantastic. Thank you everyone for attending. We will keep you posted on the next CORA College events and topics. If you have any suggestions, please email us at info@coracap.com, and we will take them under advisement and think about what our next sessions will be. But thank you all very much, and we'll be in touch soon.
Thank you.